$200 billion. China has lost this much from its market as its decoupling from the rest of the world seems to be speeding up. Chinese markets are witnessing a significant outflow of capital from stocks and bonds, which is reducing the market's influence in global portfolios. What is market decoupling? Are Chinese stocks unattractive to global investors? We tell you in this video. Hello and welcome, I'm Pallavi Sharma and you are watching Moneywise with ET Now. Let's begin. Before we start, let's understand the term market decoupling. Decoupling in layman terms means creation of gaps. But in financial terms, decoupling occurs when different asset classes or even markets that generally show positive correlations begin to move in opposite directions, meaning when the markets don't move as expected. So what is happening in China? Foreign ownership of China's equity and debt have declined by around 137 trillion yuan, which is 188 billion in dollar terms, and 17% decline from a peak to the end of June this year, as per reports. The departure occurred at the same time when Chinese economy is witnessing a slowdown due to COVID-19 restrictions, a housing market crisis, and ongoing hostilities with the West. The world is now looking for an alternative to China. As a result of this, since 2020, very few foreign funds have invested in Hong Kong's stock market. There are several factors contributing to this. Number one, China's position compared to other emerging markets. Before this year, it was believed that China's weak market would negatively impact the rest of the world, especially the emerging markets. But this did not happen. The MSCI China index is forecasted to be down around 7% in 2023, which is the longest losing streak in more than 20 years. Investors then sought gains in other regions like India and Latin America. The larger MSCI Emerging Markets Index increased by 3%. The disparity has come from China's efforts in becoming self-sufficient in all supply chains and its deteriorating relations with the US, which made other economies less vulnerable to its ups and downs. From over 30%, China's weighing in emerging markets gauge has declined to nearly 27% currently. The introduction of equity funds that exclude China have already reached a new yearly high in 2023, which indicates that a strategy to exclude China from emerging markets portfolio is gaining acceptance. Number two, international investors are pulling out of government bonds. As per reports, international investors have removed nearly $26 billion from Chinese government bonds in the debt market in 2023. They invested a total of $62 billion in notes from rest of the emerging Asia. Further, over a half of $250 billion to $300 billion inflow that came along with China's membership in government bonds indices has declined from 2019. Number three, yuan versus dollar decline. China's currency value against the dollar has reached a 16-year low due to the selling pressure. Yuan is depreciating as a result of the country's central bank's loose monetary policy, which also is another reason why foreign investors are avoiding local assets. Number four is the real estate crisis. China's property market is in crisis as home prices are falling, developers are defaulting, people are angry. It has entered its fourth year now and there are worries that it will bring down an already slowing economy. This is also an indication of China being entirely decoupled from the rest of Asia in terms of corporate debt performance. All of this is happening when the country economy is already slowing down. Global investment banks like Citigroup and JP Morgan have doubts surrounding Beijing's 5% economic growth ambitions due to this. For more such news and views, keep following ET Now.
If you like this video, then like, share and subscribe to ET Now.